For 2 straight years, Florida was the American dream. Over 700,000 moved in, bidding wars broke out, and home prices in Miami, Tampa, and Orlando surged as much as 60%. But today, experts warn Florida is facing the biggest real estate collapse in U.S. history. Insurers are fleeing, premiums have soared up to 500%, and a home that sold for $650,000 in 2022 now sits unsold at a loss. The sudden reversal has pushed out more than 250,000 people in just months, and the true cost is only starting to emerge. How did the nation's hottest market become the epicenter of risk and retreat? And how bad could the fallout get? Now the picture, distilled: migration, mortgages, insurance, storms, and policy collided. And the math broke. The inflow that powered the boom was enormous. Roughly 700,000 net new residents between 2020 to 2022, U-Haul indexes and census measures confirm. That tidal wave of demand pushed medians up 45 to 60% in major metros, created bidding wars, and made cash offers the norm. In some places, cash accounted for nearly 40% of sales. Builders answered, permits exploded. Cape Coral issued 4,388 new permits in 2021 alone. But the boom's tailwinds, ultra-low mortgage rates, and easy financing reversed. By 2024 to 2025, mortgage rates rose into the mid-6% range, wiping out monthly affordability for new buyers and creating a classic lock-in effect. Owners with 3% loans stayed put rather than trade up into a 6% payment. Insurance turned from background cost into market breaker. After back-to-back billion-dollar storms, most notably Hurricane Ian, losses reported near $113 billion. Private carriers pulled back, reinsurance costs spiked, and premiums climbed astronomically. In many coastal counties, homeowners now face annual insurance bills in the thousands. Statewide averages rose dramatically, and in high-risk pockets, quotes of $8,000, $12,000, and higher are common. Citizens, the state insurer of last resort, swelled to roughly 1.3 million policies, concentrating risk on the public ledger and exposing Florida to massive contingent liabilities if another major storm hits. Condo markets suffered a separate but overlapping crisis. The Surfside tragedy triggered milestone inspection rules. Buildings 30 years or older, or 25 years if within 3 miles of saltwater, must undergo structural inspections and fully fund reserve accounts. The deadline enforcement, hard compliance windows through late 2024 and into 2025, revealed decades of deferred maintenance. Special assessments landed in mailboxes statewide, letters demanding $10,000, $50,000, $100,000, and, in a minority of towers, as much as $150,000, $200,000 per unit. Those shock bills froze lending and sales. Banks and agencies tightened underwriting. Fannie Mae, Freddie Mac guidance shifted in late 2023, early 2024. FHA approvals for older buildings collapsed. Only a handful of buildings kept FHA eligibility, and mortgage denials on condo deals surged. Those combined pressures produced a measurable market shift by 2024-2025. Statewide condo and townhouse closings fell to roughly 94,000 in 2024, a 10.5% drop and the lowest since 2010, while months of supply for condos surged to about 8.2 months versus 4.7 months for single family. Median condo prices dropped into the low 300,000s in many areas, $330,000 reported in one dataset, down about 5 to 6% year over year. For single-family markets, some metros saw median declines of 7 to 15% from peaks. Cape Coral, a poster child, slid from a peak in 2022, median $430K in parts of the boom, to mid-2025 medians around $361,000, and Zillow estimates even lower in places, and nearly 8% of homeowners there are underwater. Inventory dynamics changed in a paradoxical way. After 2 years of rising listings, By mid-2025, new listings were falling month after month. May down 2%, July down 4.8%, August plunged nearly 8%, and September about 7.2% year over year. At the same time, delistings, withdrawn listings, exploded, roughly a 60% surge year over year, as owners with low locked-in rates and strong equity simply refused to sell into a worse financing environment. The result is a standoff. Fewer fresh listings, but also fewer motivated sellers. Buyers face higher rates, 6% plus, ballooning insurance, and tighter underwriting. Florida's median single-family price in August 2025 hovered near $410,000, only 4.6% below the all-time high, even as liquidity evaporated. That's not stability, it's stagnation masked by seller patience. Local examples make the trends concrete. Miami-Dade saw single-family medians near $675,000 in late 2024. By mid-2025, condo sales were down 25% year over year in some months. Broward County recorded thousands of foreclosures, 7,272 foreclosures cited in local reporting, sales down 7.1%, and market time stretched to roughly 3 months in many neighborhoods. Cape Coral's boom then bust arc included a plus 75% jump at the height, and then a 7 to 10% median slide with a glut of new home inventory, over 3,000 newly built homes on market at one point. In coastal condo hotspots, more than a third of sales closed at a loss in some zip codes, with many units accepting discounts of 50% off 2021 peaks. The human math is brutal. Retirees on fixed incomes face six-figure condo assessments or yearly insurance bills that rival pensions. Middle-class families see mortgage payments jump by roughly $1,000 per month when rates move from 3% to 6.5%. Default and foreclosure risks mount among those using low-down, government-backed loans. And federal mortgage giants have limited exposure to underinsured or structurally impaired properties. Local governments are already feeling it. Municipalities report multi-million-dollar shortfalls in property tax revenue. Examples: Broward reductions in projections, Miami-Dade drops of tens of millions, forcing hard choices on schools, services, and infrastructure. Policy responses have been messy and often stalled. State proposals ranged from one-time rebates to sweeping ideas about replacing property tax revenue with sales tax. Critics note the practical and equity problems. Sales tax is volatile and regressive, and a wholesale revenue swap would require huge rate hikes or deep cuts to services. On condo relief, proposals for low-interest state loans, hardship waivers, or targeted tax credits circulated in 2025, but most stalled in committee amid opposition from insurers, banks, and fiscal hawks. Meanwhile, lenders tightened standards, Fannie, Freddie, and FHA guidance tightened, title companies flagged shortfalls, and insurance reforms addressing litigation costs only scratched the surface of actuarial reinsurance pressures. What does that leave us with? Two realistic scenarios economists keep naming. One, a painful, multi-year repricing where distressed inventory clears, prices fall further, some neighborhoods redevelop, and demand slowly recovers. But the middle-class coastal condo is largely gone. Or, two, a structural reordering where regulation, insurance withdrawals, and financing constraints render many older coastal units effectively unsellable, pushing conversion, demolition, or luxury redevelopment while public finances and local services weaken. Either path entails years of drag, concentrated pain among lower and middle-income owners, and significant risks to regional banks and municipal budgets. So stay with Roofline Report and subscribe for weekly, no-nonsense updates that cut through the spin and show you what matters next.